In this lecture, we'll introduce the income statement and discuss revenue recognition. The term revenue recognition is important to us in the accrual environment of financial reporting because it helps us to make the distinction between when cash is received and when revenue is earned. In accrual accounting, the relevant event is when revenue is earned, and that's when it is recognised by recording it as revenue in the income statement. So we know that profit is the increase in wealth over time. We have an alternative and more direct way of measuring profit, and that is the income statement. So the content of the income statement actually talks about the performance of the core business purpose. So it's about trading and operating across the nominated period of time. Now notice specifically that in this direct calculation of profit in the income statement, we exclude contributions from owners and payments to owners. So this content now is purely about trading. And you can see the definition in the next point below from the AASB framework. The language is slightly more fulsome, but it means the same thing. So for us, the income statement does the following. It tells us about profitability, and it tells us how that profit has been earned. It relates to a specific nominated period of time. It can be used for many purposes, one very important one of which is that we can compare the actual profit and the actual incomes and expenses that we record against what we budgeted or expected to happen. And when we do that, we ask the question, did we achieve what we thought we were going to do? Or was it different? And if so, why was it different? It's a control mechanism. So being able to record this profit from trading in a direct sense allows us to get a control instrument for managing the operations of the business. Now look at what's in the box there. Profit is defined as revenue minus expenses. Now I'd like you to think back to Module 1, where I introduced you to the 5 elements in the accounting world. Remember that the elements are assets, liabilities, and ownership, and revenue and expenses. Now, if you can't recall this, now would be a good time to go back to that module and revisit it and make sure that you understand what is revenue and what is expenses. So here we have 2 of the 5 elements, revenue and expenses, combining in that formula to enable us to calculate profit. Okay, now, next important point is that profit is an accrual concept. It is not necessarily a cash flow. Underpinning that calculation and that trading environment are many cash flows, but the actual calculation of profit is not a cash measurement, it is an accrual measurement. Now let's just pause and look at the difference. Accrual accounting starts by saying that we will recognise revenue when it is earned. Recognise revenue when it is earned. Now notice in that language, I'm not saying receive the money. I'm saying revenue is recognised when it's earned. And recognition in this environment means that it will appear in the income statement and in the accounting system. Now once you have recognised revenue, then what we do in the next part is to match all of the expenses that were incurred in the process of earning that revenue. Lots of interesting words there, not chosen randomly. What we do is match all of the expenses that have been incurred as a part of the process of earning that revenue. So again, note the language here. We're not talking about cash paid or cash received. We are talking about expenses incurred and revenue which is earned. So that is the key and fundamental difference between cash accounting and accrual accounting. Now, just so that you understand the importance of understanding this difference, all accounting, except perhaps the most simple example you could think of, perhaps the local cricket club, all accounting is done on the basis of accrual accounting. Here's an example about the earning process, earning revenue. And there are two examples here. The first one, Simon Lengthen is an accountant. He performs work for a client and the client pays him $5,000. Now look what happens in the dual system in our accounting equation. The asset cash increases when the money is received, and to balance that out we have to increase something else in the system. What we increase is revenue. So revenue is earned, and revenue is part of the calculation of profit, and therefore it's part of the measure of wealth. And so by earning that revenue, equity goes up and wealth goes up. And that wealth increase is mirrored by the increase in the asset cash. Now let's compare that simple example with the next one, Wendy Lengthen, who is a lawyer. Wendy's business is different. She's on a retainer for this wealthy client. She's paid this retainer monthly in advance, and she gradually performs whatever work that client wants her to perform in the legal environment over the month. And as she works through whatever issues come onto her desk, she earns the $4,000, but she is initially paid in advance. So she receives the money, is paid monthly in advance. She receives the money, but she can't count that money as having been earned. And so look at what happens here. When she does go through the earning, well, initially it's recorded as a liability, so the cash gets banked, but because Wendy hasn't yet done the work, she has an obligation, she has a liability to do that work, and so the liability will be recorded, which will say that it is revenue that's been received in advance of doing the work. Now, when she subsequently does the work, then we can reduce the liability and increase the revenue because the revenue has been earned. So no longer is it a liability under the context of unearned revenue. Instead of being a liability and unearned, it becomes revenue and it has been earned. So equity goes up and the liability, unearned revenue, goes down. The point where we recognise revenue and therefore include it in the income statement has got a number of challenges for us. In general terms, we can say that the earnings process being substantially complete and measurable is the logical point to do that. However, there are circumstances when we look at that and we think it's not so obvious, or sometimes it can be actually quite ambiguous. A lawyer would say to us that at the point where the transaction is substantially complete, that's to say the purchaser has received the goods and services, that there's been agreement about the value of the goods and services that have passed from the seller to the buyer, and there's a reasonable certainty that that payment or obligation will be collected. That's a legalese sort of definition, but again, you'll see when you look at the number of recognition points below, there are numbers of situations where that could occur. And so recognising revenue could happen at the point where there are inputs into the processes. That could happen at various points or milestones during the production of the goods. We see that that's a situation that arises when contracts span a long period of time. And so perhaps we might be looking at the contract for the construction of a building, in which case there will be milestones where certain elements of earning will be recognised. Might perhaps be when the floor has been poured or when the roof is on. Those are milestone points. It's possible to recognise it when goods are finished. It's also far more probable to recognise it at the point where the goods are sold. And that tends to be the legal point, when we can say under some sort of legal definition that the goods or the services have been sold. That's usually the point where we would say that recognition of revenue will take place. If we're totally in doubt, then we might fall back on the receipt of cash, but that's not generally regarded as the best place to do it, because that then takes us out of accrual accounting and into cash accounting again. Here's a little scheme that you might like to work around. Start up at the top. When is revenue going to be recognised? Okay, when we commence a business, when we make purchases, receive orders, start production, throughout production, when we complete production, receive orders, so the customer is starting to come into the scene here, deliver the goods, or receive the cash. Now, some of those are clearly improbable, but as we get further around the cycle, the higher the probability is that we may be able to recognise the revenue. A lot of that will depend on the nature of the contract. Something to think about. When would we recognise the revenue if you are the local newsagent? Well, probably at the point where you throw the paper over the hedge. Would be a good point to say that that sale of the newspaper has been made. Supplier of components. Similarly, when you deliver the components to your customer, and there will be an invoice attached to those components. So at that point, ownership of the goods changes, and at some stage, the new owner has to pay for them. Think about a gold mine now. It's not so obvious here, is it? When will the gold mine recognise that its revenue has been earned? Will it be when it obtains the legal right to mine that tenement? Will it be when it's got a pile of dug up materials sitting at the top of the mine? Will it be at the point where it's done all of the crushing and the extraction, and we actually have those rather exotic looking gold ingots sitting in the storeroom somewhere, a secure storeroom, we hope? Or will it be when it's sold, actually sold, when somebody comes and purchases it? That's not entirely clear with a gold mine. Aircraft manufacturers. Here's another tough one. Building an aircraft will generally take quite a long period of time, particularly with the large ones. It may take a couple of years in order to actually complete the building of an aircraft. And so at what point will the manufacturer be recognising revenue earned? Will they have to wait until right at the end of that building process, the point where the new owner, be it Qantas or the American Air Force, whoever it is, where they actually take delivery of it? These are all things that we have to ponder and make a decision about. Often it'll be based on some sort of contractual arrangement. But there are situations, as we can see, where it's not always clear. When those situations arise, that's when we fall back on accrual accounting and we ask ourselves the question, has revenue been earned?